The unique opportunity in the UK property market is outside of London, prices haven't actually moved for 10 years. So on a valuation perspective, price to income in these cities are trading at 5 times. This is very different to Sydney and Melbourne, where prices have run hard and are trading at 14 times and 11 times respectively. Brisbane similarly at 11 times as well. Interestingly, because prices actually haven't moved for 10 years, the rental yields are very high. So the median rental yield outside of London is somewhere from 7 to 7.5%. If you put that against a backdrop of a very low interest rate environment, quite interestingly, you're able to get positive gearing. So if you take our example from Fund 1, we realised a gross rental yield of 8%. We borrowed at 2.5%. There's actually quite an accretive dividend yield impact from the leverage. We find that the opposite of Australia, where banks have probably lent too much, prices have run hard, which has dragged rental yields down to 3 to 3.5%, the cost of loans above that, and you're actually sitting on a day one loss. So on many metrics, we find the UK property market in the opposite direction to what we're seeing in Australia. The focus of the fund is to be very selective in what we feel are tier 1 cities outside of London that will outperform from a population growth, employment growth, wage growth, as well as infrastructure spend. So if we take our Fund 1 as an example, we invested heavily in Leeds, Manchester and Birmingham. Birmingham has had the experience of Deutsche Bank, HSBC, Santander move all its middle office from London to Birmingham. The whole BBC moved from central London to Manchester, and we're seeing a huge amount of infrastructure spend in some of the tier 1 UK cities, such as the high-speed train. So the fund is really selective on the key tier 1 cities that we believe will outperform from a gentrification perspective that really enhance capital values over the longer term. So similar to Fund 1 that was raised last year and fully deployed, we're investing in large blocks of apartments that we can buy in bulk and a discount to open market values. You don't see this so much in Australia, but there's a proper secondary market in the UK where you can buy of banks, developers, housing associations, where we typically don't take on any construction risk, no development risk, fully built, tenanted property that's income generating for investors from day one. Ultimately, there is uncertainty around Brexit, but we've looked at the fact base. So post the UK referendum 2 years ago, quarterly GDP continues to be actually very resilient, but not stellar. The employment market, which is very much correlated to house prices, continues to strengthen. So unemployment rate is now at 45-year lows at about 4%. Real wage growth is now running at 3-year highs. I think what Brexit or the weaker economy environment has created is a very low interest rate environment, which is attractive for the fund from a borrowing perspective. It's created a very weak pound to the Australian dollar, which gives a lot of upside over the longer term. And from an investing perspective, we're investing outside of London in tier 1 city centres such as Manchester, Leeds and Birmingham, which will actually benefit from a lot of the corporates relocating from London to these cities. The target return for the fund is a 6 to 7% dividend yield. We feel that is relatively resilient, just driven from a base case of 7 to 8% gross rental yield that will be achieved from the properties that we invest in. We then ask ourselves, what do we have to believe to get to the 10% net total return back to investors? With a 6 to 7% dividend yield, you'd only have to deliver 2 to 3% house price growth per annum, which we feel is conservative. The long run UK house price growth rate is 6%, dating back to 1952. If you look at the current growth rates of these cities, where they haven't moved for 10 years, they've now started to recover over the past 3 years to grow at 6 to 7%. So we feel that there's a very stable dividend yield return to investors of 6 to 7% per annum, with substantial scope for upside based on house price growth. So this fund is run by the L1 UK team, fully based in London, led by myself as CIO. Similar to Fund 1, we'll be investing in large blocks of apartments. In Fund 1, we raised a total of 65 million Australian dollars. That was deployed in approximately 6 to 7 months. For Fund 2, we're looking at a target raise of 150. So the specific focus to keep the fund size relatively small because we succeed when we invest in good properties, good locations at compelling prices.